Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now, to the show at hand.
Hi there, Yoni Schmidt here, hosting today's episode of the Same Day Podcast, where I connect with top business and real estate leaders. Past guests include Chip Gabrino, a local restaurateur entrepreneur, Elliot Nelson, the CEO of the McNally's Group, and Morgan Martin from Merrill Lynch. Today's episode is brought to you by Keyrenter Property Management. We are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. That is why no matter what rental you have, a single-family home, a condo, townhouse, an apartment, we have the management solutions for you. Go to KeyrenterPMC.com or email us at info@KeyrenterPMC.com. Today's guest is Luis Belmonte, a highly seasoned real estate developer with over 57 years of experience in the field. As a principal at Seven Hills Property, Luis focuses on retail, multifamily, and industrial developments across California, Oregon, and Nevada. He was also a founding partner and executive vice president at AMB Property Corporation, now known as Prologis, where he spearheaded major real estate projects globally, including in the US, Mexico, Japan, and Singapore. In addition to his extensive real estate career, Luis is a US Navy veteran and an accomplished author of Real Estate 101, Street Dog MBA, and Street Dog Negotiator, where he shares valuable insights and strategies for thriving in the real estate industry. Today is here to offer his wisdom on surviving economic downturns, strategic real estate pivots, and street smart negotiation tactics, which I'm very interested about. Welcome to the show, Luis. Thank you so much for being here.
Great. Glad to be here.
So Luis, it's Luis, right?
Louis.
Louis. Okay. My name gets butchered all the time, so I can relate.
It's my mother's fault. She named me after an old boyfriend in San Luis Obispo. So, I didn't have any choice in the matter, but people have been mispronouncing it and misspelling my life. So I'm used to it. Anyway, I go by Louis.
Okay, great. I'll call you Louis. So tell us, with over 57 years in the real estate industry, you've seen the industry evolve significantly, right?
Horrendously.
Tell us about some of the most pivotal changes that you've witnessed.
Well, probably the most pivotal change in our industry came in 1986. Prior to 1986, we were all in the tax evasion business. You raised money by selling deductions. So the archetypal deal in the 70s and 80s was based on the tax code and inflation. So kind of the deal was the garden apartment with a HUD loan, as big a loan as you could get because interest was deductible, a big developer fee on a ground lease so you could write off the ground lease payments, and you were producing write-offs of $2 or $3 per dollar invested. So if somebody gave you $1, you'd give them $2 or $3 worth of write-offs, so they'd get their return immediately if they were in the 50% tax bracket. And you might or might not get your money back. The deals I did with Lincoln Property Company were much more conservative. You got about a 1-to-1 write-off, but we sold equity, and in return, you got all the depreciation and all the tax losses generated on the deal went to the investor, and they got a preferred return and a piece of the profit if there was one, and that was our business. And because inflation was very high, if you even with maximum leverage over 3 to 5, 6 years, you could roll over your leases, raise your rent, sell the building for considerably more than you paid for it, pay the investor back their investment, give them some return, and you would transfer ordinary income to capital gains, moving it from the 50% rate to the 20% rate. Everybody was a happy camper. Come 1986, they passed the Tax Act, and it went into There was a Senate bill and a House bill. They went into conference committee. What came out wasn't what anybody expected. So the highest rate went from 50% to 28%. There was no longer ability to take investment losses and write them off against ordinary income. And suddenly every commercial developer in America was out of business. And they all went broke whether they knew it or not. And prior to 86, developers owned property. Subsequent to 86, the money owned the property, institutional investors, private equity. So most people in the development business today are simply indentured servants to some money source. I mean, if you're in the leagues, I'm not talking about house rehabs and little apartment deals, but if you're doing big deals, you're working for the money. You're working for a private equity shop or an institutional advisor or something like that. And you're working at earnout deals. So, the investor gets a cum preferred return and you get a percentage of something above that. Now, the reason, that I no longer do big deals like I did in corporate life is I don't want to report to an investor. So my partner and I did some merchant building for a national retailer to build up our balance sheet. So we're mostly our own equity now. We don't have to go to a financial source, but we only do smaller deals. And kind of my motto is every deal's $1 million deal. If I'm doing $100 million deal, I get the last million if it's there. If I'm doing $1 million deal, it's my deal. Either all of the equity or most of the equity is mine. And so we do, what I want to do. If I'm doing a bigger deal, I do what the investors want to do. So and so that's the biggest change that's happened in our business, in my business career. And I guess the corollary is that in the 70s, we had high inflation and interest rates at 9 or 10%. And then we went for 10 years with artificially low interest rates, and everybody got seduced. And I stood behind podiums at industry events, waving my arms for 10 years, saying, this is going to end. These interest rates make no sense, inflation adjusted, borrow now, fix long, watch your ass. No variable rate loans. You're going to get your ass kicked if you do that. And I was wrong year after year after year until a year or so ago, and then I was finally right. But the artificially low interest rates led to a whole lot of misallocation of capital and a whole lot of people taking risks that they should have taken. And the chickens are now coming home to roost all over the place. I mean, there's more defaults going on, more write-downs going on than you can jump over, and it's going to be ugly for the next year or two or three.
Yeah. So tell us, I guess, how can someone capitalize on that if they were to, keep their finger on the pulse of the market, right? Where would you imagine there would be opportunities?
Okay, so I will start by quoting my former boss, Hamid Moghadam, who is the chairman and CEO of Prologis, where I used to work, the largest REIT on earth at this point. And his line is, big money in real estate is made by those who have cash when nobody else does. And that's number one. So right now, you can buy quality office buildings for 20 cents on the dollar because the lenders are bailing out. And so and the values have come down dramatically. It's going to take a few years for the market to recover because the supply and demand dynamics have changed, but you're going to be able to buy stuff well below replacement cost. If you can buy a product well below replacement cost where supply and demand will eventually stabilize and you have the pocket and the tenacity to hold on, you are going to make money. The other thing that's available out there is you can go to smaller lenders and buy loans because the regulators are on the ass of lenders to get the real estate off their books. REO, real estate owned, is not what a lending institution wants to have on its books. They need to get rid of it as soon as they can. If you've got cash or you can raise cash, you can go to a lender and say, you got any loans for sale? And they will sell you loans for less than the face value. And then you can either collect on that loan and make a high return, or if the loan isn't paying, you can loan to own, foreclose on the property, and buy something well below replacement cost, which is the key to happiness, in my view.
Mm-hmm. Yeah, because the cost would essentially be, if you're foreclosing, the cost would essentially be, whatever you paid for that debt plus whatever attorney fees and
Yeah,
legal
it's
fees and
cost of the loan plus cost of the lawyer. You're the owner.
right. Yeah. Have you ever gone through a process like that, I guess, where you went out and bought debt?
I have been through foreclosure stuff on several occasions. It requires some tenacity. It's like the Johnny Cash song, "You're in the street with the mud and the blood and the beer." But if you're prepared to do that, you can make money at it.
Yeah. What are common pitfalls that you would recommend someone, an investor that's coming into the market, looking at foreclosure opportunities or perhaps even debt opportunities, to watch out for?
Well, first off, you got to decide whether you're a real estate person. So, and that takes a certain type of personality. I mean, you're in the property management business, the bottom of the hill down which stuff runs. I mean, you get all the plugged up toilets and bitchy customers and crazy people and cockroaches and all that stuff. If you're unprepared to deal with that, don't get in the damn business. I use third-party managers in my business for some of our remote assets, but we manage some ourselves. So that we manage our own low-income assets, and
Mm-hmm.
I'm prepared to manage anything. I used to do joint ventures with developers when I worked for the predecessor of Prologis, and we'd go contract with a local developer in the '90s who had no money. They'd build the building for us, and we'd be in partnership, and then we'd split the upside. But I was always prepared to go to the job shack and run the damn job if something went wrong. And if I've got a manager who isn't performing, I can toss the manager out tomorrow, go manage the damn thing myself. For years, in my own personal assets, I did all my own maintenance work because I'm such a cheapskate. My son's
Mm-hmm.
now running the buildings, and he hires it out because he thinks his father is nuts. And now I can't do my own maintenance because I'm too old and my skin's too thin and I bleed all over everything. But
Mm-hmm.
I know how to manage property and I don't mind it. I've unplugged a lot of toilets. I've run a lot of evictions. I've stood on a lot of doorsteps, served a lot of paperwork, and and I know what I'm looking at when I look at a real estate deal. I mean, I used to do a lot of market research and a lot of investor relations in a helicopter, and I can look at a site and tell you what belongs there based on a lot of experience and my notes. And I once contracted to buy a piece of land in Fresno, and I came back and I talked to my boss and I said we wanted to open in Fresno, and he said go out and find something. And I went out and tied something up, and he looked at the map and he said, well, our stuff isn't where all the other players are. And I said, that's because all the other players are in the wrong place and I'm in the right place. And he said, well, I'm sorry, but I don't trust your judgment that much. So we got in a plane and we flew out there. And as soon as we flew across the site, he said, you're right. You got the right place. It had everything going for it. It was an industrial building. It was on a rail line. It was next to a freeway interchange. It was the right shape. It had the right traffic patterns. But I took one look at the site and that what was supposed to be there because I had a lot of experience and I got a real estate nose, and that's my business. As a stock investor, I'm mediocre at best. I'm not so good at balance sheets and footnotes. And I always stay on the shallow end of the gene pool. Every time, with one exception, that I've done a pretty deal, I haven't made any money because design ain't my thing. High end ain't my thing. I do working class apartments, dingbat neighborhood retail, industrial buildings. I'm in the shallow end of the gene pool where I belong. So the
Mm-hmm.
first thing you need to figure out is, are you a real estate person? Is it something that you're okay with that interests you? And My wife and I have traveled all over the world, and she claims I can find the industrial area in any city on earth. I've looked at warehouse buildings in Paris, and that's not normally where tourists go. But warehouse buildings interest me because I built them for 35 years. So that's the kind of a person I am. So you need to figure out what kind of a person you are before you get into the real estate business. And this, you're in the business. You can look at a property and know what's wrong with it. You can assess tenants. You can do all of that stuff. If somebody can't do that, don't get in this business.
Yeah, absolutely. It takes a lot. And, I just got a work order from one of my rental properties this morning that there appears to be a mouse in the plumbing causing some sort of leak. So I'm thankful for sound property management that can deploy the right vendor to go out there and take care of the problem, so that I can spend this time with you and have this conversation. Switching gears a little bit here and talking a little bit about your book, Street Dog Negotiator. You emphasize in the book street smart negotiation tactics. Can you share, I guess maybe a little bit about that, or maybe one of your most valuable negotiation lessons?
The mantra is this: in any negotiation, he who cares least wins. He who cares least wins. You need to attempt to approach every negotiating situation with an attitude of indifference. If the deal makes, if it works for me, fine. If it ain't going to work, if the other team has objectives that I can't meet and still meet my objectives, it's time to say, guys and girls, this ain't working. I'm sorry. Get up and leave the room, and never look back. Never turn around. Never put any hesitancy in your step. Just walk out and say goodbye in your head. If you are indifferent, you are going to win. Now, in some situations, you're on the low ground. You can't be indifferent. But you need to be ultimately realistic, ruthlessly realistic about your situation. And if you're going to cave in because you have to, then just get the best deal you can and get out of there. But assess the who has leverage ruthlessly, and if at all possible, be in a situation where you don't care. So let's say I want to buy something from you. Let's say I got a tenant in hand who wants me to build a building for him. I'm going to do a little merchant build deal. I got a customer who wants a building. I got the specs. I know how much it's going to cost. So I know how much I can pay for the land. And let's say I want to make a 10% spread. So I build in a 15% spread because something always goes wrong. There's the oops stuff that comes up every day if you're doing a deal. So, you got kind of a 5% slack and 10% margin. I say, okay, here's what I think I can sell it for. I want to make 15%. So here's what I got. Here's what my cost is going to be. I know what the building's going to cost. I know what the soft costs are going to be. So I know what I can pay for the land. So I come to you and I say, okay, I'm going to give you $100 for your piece of dirt. And you say, oh no, I want $200. Well, my answer is, okay, if you want $200, I ain't got a deal here. So, I'm sorry, this just doesn't work for me. And away I go. But if you need the money, you're going to stop me as I walk out the door and say, well, how about 150? And I'm saying, I'm sorry, this is my number. And if I don't care, then either you come to where I need you to be, or we haven't got a deal, and that's the way it goes. So onward and upward. So the same thing if I'm a seller. I got a price that I think meets the market, and either you want to pay that price or you don't want to pay that price. If you don't want to pay that price, we ain't got a deal. And I want to be in a position where I'm never forced to sell anything if at all possible. So that's why I have long-term fixed rate debt. That's why I keep my leverage low. I don't want to ever be against the wall where I got to do something if at all possible. And if I got to do something, then just take the pain and go on about your business. But the attitude of indifference in a negotiation is the strongest thing you can have going ever.
Interesting. Well, I have to remember that going into my next deal. You've been pretty vocal about, challenges in building low income housing in, high cost areas, right? Such as San Francisco,
Yeah,
which
absolutely.
is where you currently are. Given the economic environment that we have been facing over the last 2 years, with very strong inflationary pressures and high interest rates, what strategies do you think help make affordable housing more feasible?
Well, the first thing is this: the anytime the government involves itself in an industry, well, the great line is from, and I can't remember his name, the University of Chicago, Milton Friedman. He said, if you put the government in charge of the Sahara Desert, within 5 years, there'd be a sand shortage. And that's the way it is. So the more regulation there is, the more opportunity there is if you're able to cope with the regulation. So if I go to, say Tulsa, Oklahoma, to build low income housing, it's going to be easy, but I'm not going to make much money because everybody else can build. If I can manage to get something built in San Francisco, we're getting outrageous prices for a room and a bath in San Francisco. We're getting more than you're getting for an apartment in Tulsa for one room, because the supply is constrained, because the government makes it so hard to build. So the question is, can I overcome all the obstacles? Can I work the system to get something produced? Because the government has generated a monopoly for me.
Hmm.
I got the lowest price in town, even though it's an outrageous price. So a house in your market, good looking house costs 400 grand. Same house in San Francisco costs $1.4 million. What's different? Is the drywall different? Is the lumber different? It's the government that's different. So,
Hmm.
I need to work the government to get something done. I need to understand all the rules. I got to figure out who all the influencers are. I got to figure out the regulatory climate. And if I do all of that, and I'm prepared to go through that brain damage, which I'm only prepared to do every now and then because you got to forget how painful it was, then I can produce a product that's we don't even have an advertising campaign. We don't even have a phone number on the front door of our low income place. We refer Craigslist listing once a week. That's our marketing program.
Hmm.
I mean, it's once you get it up and running and you're able to follow all the rules, the thing leases itself. In places it's easy to build, it's hard to lease. In places it's hard to build, it's easy to lease. So in coastal California and in general in the coastal United States, land doesn't have value. What has value is the building permit. So
Hmm.
when my partner and I were doing build-to-suits for a national retailer, we took on the reason we got business is we took on all the jobs that were hard to entitle. So what we were bringing to the table was the ability to get a building permit.
Hmm. Interesting. So in your book Real Estate 101, you provide some essential real estate investment tips, right? What are some of the most common mistakes that, you see new investors make, and how can they avoid them? Of course, aside for the obvious adjustable rates that, like you said, put you in a corner 3, 5, 7 years down the line.
Well, the first thing is, one way or another, get enough equity in the deal so you have some room. So your own money or investor money of investors that you have an appropriate relationship, whatever it is, you know, don't get too much leverage. Now, if you're doing apartments in a dense market, uh, uh, you can have 75% leverage, especially if you can get it from HUD. That's okay. But if you're buying a spec office building, cheap for long-term hold, waiting for the market to recover, you want to make sure your debt is such that you can service it with very little occupancy.
Hmm.
So, you get your leverage in the right place for the deal, but don't over lever, because then your risk just go crazy. The second thing is, uh, um, you got to balance your risk and reward. So if a deal is going to be brain damage and take a lot of time and is in a marginal neighborhood, so if I'm buying a AAA net leased at the corner of Main and Main, then a 5% return might be just fine. if inflation is 2.5, 3, I'm making, a real 2. Okay. If I'm buying a pool hall in Barstow that's also a meth lab, where the constituency is rides motorcycles, I'm going to have a hard time collecting rent and may need to buy a firearm or hire a bodyguard. I'm going to have to go out there with my hand out to get my money. Then I want a 20% return. So you gotta figure out how much brain damage is in the deal, how much risk is in the deal, and say, okay, I ain't buying a meth lab at a 5 cap. I got to have a 20 cap or a 25 cap. So you get that correct. The next thing is stay in your wheelhouse. Be an expert on some subtype of property, some neighborhood. So, in the immortal words of the country song, you know when to hold them and when to fold them. So you should always want to buy when the market undervalues the asset and sell when the market overvalues the asset. You're not going to know that unless you're a local expert. So if you know your area block by block, you can see a building that's got a price that you say, I'll put some lipstick on this pig and it's worth thus and such. So one of the first deals I did is a partner and I bought a house in San Francisco out of an estate. And, we had no money. We were punk kids. And so it had been a rent house. It was beat up. And we bought it for $28,000. To show you how things have changed, that same house today would sell for $1.4 million, but we bought it for 28 grand,
Wow.
$2,800 down, 90% loan, 2 years. So, and we decided we'd create a masterpiece. We refinished all the hardwood floors. I rebuilt all the double hung windows, replaced all the sash cord, new glazing. I mean, they worked perfectly. They were the best double hung windows in San Francisco. We put in a new kitchen. We added a bathroom, big time landscaping, big new deck. And then we ended up, interest rates had gone to 9.5%. And in order to make money, our house was priced at like $55,000. Well, this was a dingbat, post World War II, cookie cutter neighborhood. The going rate was 50 grand. And so we over remodeled the damn house because we thought we were artistes. And no matter how good our product was, it wasn't going to sell for a market would bear, especially in a 9.5% interest rate climate. We got our ass kicked. We barely made wages. And I learned my lesson. You gotta look ahead to your exit. You got to stay in your wheelhouse, and you got to figure out where the money is. Now we could have gone into that house with a little paint and carpet. And by the way, the guy who bought the house put in aluminum windows and wall-to-wall carpet over our hardwood floors. That's as close as I've come to crying since I was 5. So I learned my lesson. Go in, white paint, new lawn, put a for sale sign up. We could have sold it for 48.5, made great money and gone on about our business. So you need to look through what's realistic ahead of you and stay disciplined instead of getting delusions of grandeur. If you're doing dingbat deals, do dingbat deals. Now, I know people who make money in the taste market who sell and stage multi-million-dollar homes, who do rehabs on mansions. That's fine, but it's not me. And a lot of them really get hammered when the market turns or interest rate turns. And you can do spec houses in Bel Air and sell them for $100 million and make 30 million, but you can also lose 30 million. That's just not my business.
Yeah. High risk, high reward.
Yeah.
You mentioned discipline a moment ago. Your military background must have instilled a strong sense of discipline and strategy in your life and your career. How has your time in the Navy shaped your approach in business and real estate?
Well, it taught me the most important thing that the military taught me was the nature of stress. So I'm in Vietnam and I'm the naval gunfire officer for the 1st Marine Regiment. And for the most part, I didn't see combat. most of the time I sat in a bunker surrounded by sandbags with a bunch of radios coordinating fire support. But occasionally I went into the field as a forward observer. And the key people in this situation were company commanders. So, they're out on an operation and they got 3 platoons of people to run. And so what happens when they get hit? So you're there and the shooting starts and the screaming of the wounded and the stench and the dust and the chaos. And you got to stand there and you got to say, okay, I need to maneuver my platoons. I got to decide whether I'm going to advance, retreat, or dig in. I got to call my battalion commander, let him know what's going on. I got to talk to Belmont and get some artillery in here and decide where it's going to go and how much. I got to arrange for medevac, and I got to get my corpsman out there, and I got to do all this with people shooting at me, and the people who were good at it were absolutely cool, and it didn't make any difference whether they were he-men or mouses with thick glasses. The guys that had battle sense could do it, and those were the people who advanced in the Corps. And what it taught me is that all stress is inside me, not out there, because you could not find a more stressful situation. But these people had training and kept their cool and kept judging the situation under the most severe circumstances. So anytime I'm under stress, anytime that something's going on, I say, oh God, it's all inside me. There's nothing out there. So what I need to do in any stressful situation is look in the mirror and say, what are you afraid of? And analyze my own situation as opposed to blaming somebody else or blaming circumstances. So it's all inside me. That's where the discipline has to come. And then I need to understand where my wheelhouse is and where my wheelhouse isn't. If I'm looking at a real estate deal and my nose is twitching, I know something's wrong and I know I'm right. If I'm outside my wheelhouse, I better find somebody whose wheelhouse this is. So I'm a big believer in hiring expertise when I get outside my wheelhouse. I want somebody who knows exactly what they're doing. So, if I'm buying units in your neighborhood and I'm going to hire a third-party manager, I don't just go down and look at the unit and decide, well, this is the right block or this is the right units or this is the right price. I come and talk to you and I say, I'm thinking about doing a deal here. I'm looking for a manager. How about you come and look at me and tell me what you think, because it's your turf and your block. So, anytime when I went overseas to do deals, before I did a deal in Mexico, we spent a year interviewing partners. And so we eventually ended up with a partner, and I built a lot of warehouse space in Mexico City or north of Mexico City with a local partner who didn't know squat about warehouses, but he knew a whole lot about the political situation in Mexico, which turns out to be the most important thing in Mexico because nothing goes on unless the political stars are aligned. So my deal with him was, okay, you teach me Mexico, I'll teach you warehouse, and between the two of us, we'll build something. But I never thought I could go to Mexico and do deals because I'm going to get local to death. So anytime I'm outside my wheelhouse, I have to have the humility to understand that and find somebody like you who knows the neighborhood. And let's say I'm building a deal in your market. I got a piece of land, I'm building something, and you're going to be my manager. I'm inviting you to the architects meeting so you can tell me where to put the hose bibs and how to work the gutters and where the plumbing lines go. And maybe I got a sewage system I got to build, where the leach lines are going, and which soils engineer I got to hire to figure out if the site's going to perk and 1,000 things like that I ain't never going to know about your market.
Yeah, that's very interesting. So much knowledge from such a I guess five decades of experience in the industry.
My entire body's covered with scars. stuff I've screwed up.
Yeah. Well, we all have to fail forward in our lives, and one of the ways to do that is by going through the motions and experiencing it.
Well, that's and the thing about the development business is, after all is said and done, the only way you learn how to be a developer is to develop things, and you're going to make mistakes. There's no question about that. And you and the important thing is start out small, because you're on a small deal. Your small disasters won't send you to the bankruptcy court. If you go big time and screw it up, then you're pretty much done. I mean, a few
Right.
people come back from that, but not many. So, learn your mistakes along the line and develop your instincts as you go, and then you'll get better at it as you go. And then you tend to see bad things coming sooner, and you're able to mitigate them sooner.
Yeah. Tell me, I guess, with a career that spans over 5 decades, what's been your proudest accomplishment as a real estate developer?
My proudest accomplishment is founding a little company where we don't report to the overhead, meaning we've set ourselves up where we don't have to do any deals. So right now, my partner's children are all in college or beyond college. He wants to kick back. We've just put it in neutral. We don't need to do anything. Our system runs. We aren't under any pressure. We don't have any loans rolling over anytime soon. We've set things up where we can open the door and close the door based on the market, because the general rule of thumb is development deals work just fine in a rising market. They don't work worth a bean in a falling market. So what you want to do is you want to enter the market when it's at the bottom or somewhere close, and get out of the market as it improves. And don't try and call the top. Just when it gets real good, pull back. And when the land prices start to get crazy or cap rates get really compressed, it's just time to say, I'm going to take a breather here. And
Hmm.
and then, I mean, if you look at one of the great investment careers in history, which is Warren Buffett and his partner Charlie Munger, their motto is, we want to buy when everybody's selling and sell when everybody's buying. And that's where I want to be. I want to be able to go out and do a deal when everybody's running away. And it doesn't mean you're 100% right. I mean, you could have gone to Houston in the 80s and bought something and still got your ass kicked, which I did. Because the market kept going down, and the oversupply of multifamily got so bad that they were bulldozing buildings. So
Hmm.
it's possible to miss the bottom also, but generally speaking, when things bottom out, you can kind of figure, you can't call the bottom, but you can get somewhere close.
Hmm.
So if there's 100 million feet of vacant office buildings in Manhattan today, as an example. So if you go to Manhattan and you buy a C building for whatever cents on the dollar, you might very well get your ass kicked, because the C's may never fill up. But if you manage to buy an A or A minus building well below replacement cost, and you've got a plan to hold it for 5 years, you're undoubtedly going to make money, because
Hmm.
Manhattan isn't going away. And if you buy in right and you hold for a while, you will make money. So,
Yeah. Love that. So, lastly, what advice would you give a young, aspiring real estate investor who is just getting started in today's competitive market, aside from buying, A-class buildings in Manhattan for less than replacement cost?
well, the trick is, um, number one, you want to save some money. And the way to do that is save first. So anytime you get a dollar, save 5 cents, and then go spend the 95 cents on whatever you have to do. But every month, save 5 cents or 10 cents or whatever it is. Anytime you come into money, just put a little bit aside, and don't get cute. If you're not an investor type, buy treasury bills or AAA munis or a CD, or don't get cute, because you ain't an investment professional. And if you want to get good at buying stocks and bonds, get good at buying stocks and bonds, but don't assume you are, and don't give the money to somebody who's going to invest on your behalf, because they're in it for the fees. And everybody does what they get paid to do. So just put aside a little money so you have some capital, because nobody who's got 3 brain cells is going to invest with you if you don't have skin in the game. So you got to have some money. And then you got 2 ways to get good at this. You can go to work for somebody who's doing it and learn on their dime, or you can do it yourself. And either works fine. If you go to work for somebody, you can see how they do it, see the mistakes they make, see the markets they're in, see which markets you like, maybe cultivate some investors, and then go out on your own. Or you can go do a little deal. You can buy a rent house, you can buy a duplex that's beat up, some small deal that where you put up a little capital. Maybe you got a friend or two who will throw in with you, and work the deal. Go out, fix it up a little bit, raise the rents, sell it, see if you make some money, do a couple more, and then you get into the stream. You get to know some lenders, you get to know some investors, and you got a track record. You can write up a little resume, say, these are the 3 deals I did. This is how it came out. This is the IRR that I made on the deal. Here's what my investors made. Here was our business plan. Here's what I propose to do going forward. And then people will invest money with you. And then you know which level to go to and how to negotiate a loan, and you learn a little bit about construction. Because if you're going to be any good at this, you got to learn something about maintenance, management, construction, architecture, finance,
Mm-hmm.
demographics, all kinds of stuff. So, and you're not going to do this until you wade in and do it. And I don't think once a year, I'm a guest lecturer at a class at Stanford in real estate development, and I can tell people a few things. I can recommend that they read my book, but I can't make developers out of them. And a few of them have got the instincts, and you got to have a hard heart and a ruthless mind, and be willing to break some rules, and be willing to be a villain in front of public meetings and all kinds of nasty stuff. Very few people have that mindset, and very few people will come out of that class and excel in the development business. I mean, you're a property manager. How many people want to do what you do? It's a hard business. It's a hard way to make a living, and you put up with a lot of grief, and a lot of sniveling and a lot of complaining, and you're a bad guy when you show up on the door to collect rent. Not everybody's up for that.
Yeah. Yeah. We deal with that a lot, managing about 3,000 properties in 5 markets. So we're quite familiar with that. And, it's not always up to us. We don't own all of the assets that we manage. And these are investments at the end of the day. People buy them to build generational wealth for themselves and their families, and they run them as a business as they should. Louis, this has been a very inspiring, eye-opening, educational. I want to thank you for your time here, sharing all of this with us. And anything that you would leave us with?
I have to say that I got into the real estate business accidentally. The first deal I did was in 1962. I sold a funky little duplex in Corning, California that I inherited from my father. And I've been doing it except for the time I was in the military ever since. And it's been an incredibly rewarding career. And I do deals in my old age, and I am older than dirt, giggles. And my partner and I have a single criterion when we're looking at a deal. Is this going to be fun or ain't it? And if it's going to be fun, we do it. And if it ain't, we don't. And I cannot wish for anybody a more rewarding way to spend your business life than doing something that gives you a sense of satisfaction and gives you some giggles. And that's what I'm in it for these days, is the giggles. And it's such a blessing. It's hard to convey how grateful I am for the career I've had.
Love that. Thank you so much. Thank you for your service. Thank you for sharing. If you haven't already, go check out his books and reach out to us. If is it okay if they reach out to us if they want to connect with you?
Absolutely. You can go on Amazon. The books are cheap. There's Kindle and paperback. It ain't like I'm in it to make money. I write the books for giggles too. So, and hopefully you will get some ideas and a few wise ass remarks, which is my mission in life. And it's been a lot of fun to be on with you.
Thanks so much, Louis. Chat soon.
Thanks.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.